Okay.
Good morning and welcome. We are excited to welcome Connor to the Brother Rice Real Estate Club. He is a graduate of Brother Rice High School. Connor was from the class of 2016, and he has built a successful career as a real estate developer, shaping communities through his work in the industry. With hands-on experience in development, investment, project management, Connor brings valuable insights into what it takes to succeed in real estate and how to build long-lasting relationships along the way. Please join me in giving Mr. Gleeson a warm Brother Rice welcome.
All right, thanks for having me, guys. Thank you for joining me on this early morning. Just telling Jason back there, I grew up at like 14 in Lasser, and there were many times where I would just roll out of bed at 7:45 and just try my best to make it to school on time. So, like you said, what you guys are doing is really great. You guys are in a really good spot to position yourselves for the future, get yourself ready for college, and eventually, land a job out of college and get your career started. I'm assuming you guys are all here because you at least have some sort of interest in real estate, commercial real estate. What I'm going to do is just tell a little bit about myself, kind of how I got started in my career, and then I'm going to tell you a little bit about real estate development, and have a little fun exercise at the end. I'm going to challenge you just a tiny bit. I want you guys to learn something today. So, all right, I'll get started. All right, so I said I grew up in Bloomfield Hills, graduated from Brother Rice in 2016. Went to Michigan State, majored in finance, went to the business college there, Eli Broad College of Business. I worked for a year out of college for the family construction company. I'll get a little bit more into that about what we do and how it differs from real estate development. But I worked there for a year. I knew I wanted to go into real estate, and so I did this accelerated full-time MBA program at DePaul University in Chicago. So I started in September of 21, and then I did the real estate finance and investment concentration. So at first I did more general business kind of administration classes at DePaul. I did, finance, accounting, marketing, all that type of stuff, and then I sort of focused specifically on real estate finance and investment, which was nice, and not many graduate school programs offered that program, so that was really nice to kind of get involved with real professionals who had worked 30 plus years in the real estate industry. So my work experience, like I said, a year out of college, I worked for CE Gleeson Constructors. You guys might have seen our signs around and stuff. We've done renovations for the school, starting with we redid the A wing and the C wing, and we did the atrium. That was kind of the next phase. This science wing, this was not here like 10 years ago, I want to say. I think this was added my junior year or maybe senior year, and so I graduated in 2016. Kind of crazy how time flies. It seemed just so new at the time when I was here in high school. But yeah, so I worked there for a year. I kind of helped out where I could. I didn't really have a specific role because I knew I wanted to go into commercial real estate, but I graduated in probably the worst time possible. I graduated in an extremely weak job market. I graduated in May of 2020, so the pandemic had just struck, and so there weren't that many job opportunities available. And so I actually started off after college working an internship for MTV Partners, which is a good family friend of ours, Mike Bailey. We've done a lot of work together with Gleeson constructors as well, and so that was kind of my first exposure to commercial real estate, and that's when I knew I loved it and I wanted to pursue it. So then I worked for Gleeson constructors for a year. I kind of wanted to, I guess, bolster my, resume a little bit, and so, hey, how you doing? And then, so I did the MBA real estate program, and then I got hired while I was finishing up my MBA from a real estate development group called IBT Group in Chicago. And so they were a real estate development firm, a little boutique firm, and what we did is we invested in and developed life science buildings, lab and office buildings. And so these life science, it's kind of a subcategory of kind of like an office building. You're investing in higher end, more expensive facilities like lab facilities for, it's supposed to be, companies mostly focused in the life science or therapeutics, just kind of pharmaceutical kind of industry. But we kind of, it kind of involved more than just life science tenants. We had tenants in quantum computing, nanotechnology, stuff that's way above my head, but we built some pretty nice facilities for them. And then we also did some multifamily, all kind of getting, I'm not sure how familiar you guys are with all the terminology, but I'm gonna help you out here. So, and then my current job, so I'm now the director of real estate development at Gleeson Development, right? So Gleeson Development and CE Gleeson Constructors. CE Gleeson Constructors is the big, I guess, parent company, you could say. So CE Gleeson Constructors has actually been around. We just had our 100-year anniversary. We celebrated that over the summer. So CE Gleeson Constructors is a general contractor, and a general contractor is hired by the owner to build a building according to the plans that are determined by the owner and the architect. So the owner will say, hey, I want to do a shopping center here. Okay, I want this many tenants, and then an architect will draw up site plans that make sure they coincide with all the fire codes, and making sure that it's aesthetically correct and all that type of stuff. And so the real estate developer is the one who invests into, who they buy the land, they acquire it, they secure financing. I'll kind of get into that in the next slide, but so that's kind of how a real estate developer is responsible for the entire process of building an entire building, of buying the land, leasing the property, right, getting tenants in there, and then the general contractor is responsible for building it. And what they do is they don't just have a bunch of guys on staff who just go in and perform all these trades. What they do is they hire what are called subcontractors. So Gleeson Constructors is a general contractor, and so what we'll do is we'll hire plumbing subcontractors, electricians, we'll hire HVAC guys, we'll hire earthwork, excavation guys, right? We have all these different trades, so we're responsible. We hold a contract and we hire all these different trades who specialize in all these different areas, and that it all comes together, and you're ultimately responsible for making sure the project is delivered on time and that it coincides with the architect's plans, and obviously making sure that the owner's happy. So when so if we develop and construct a project, we have a lot more control over the cost of the project and sort of the timeline and stuff. So there's a lot more synergy there. So right now we're trying to work on some vertical integration. Right. So as I said, real estate development is the process of buying land, improving it, building structures like houses, apartments, offices, or stores to sell or rent for use for business. So it involves planning, designing, financing, constructing properties to create value and meet the needs of communities. So we just kind of touched into that. And so I'll kind of break down what each of these really mean. So planning, that's really just when you invest into a new property, you have to get it under contract, and you have to deal with the city that you're building it with, so like the municipality, and so you have to make sure that the city's happy. You got to get it under contract, right? So that's planning. Designing, right? So that's when you get the architect involved and you design the building to your liking, you know, on the exterior, you know, how much space do you want, you know, in the middle, you know, if you're doing like an apartment building, you know, I want, you know, X amount of room for amenity space, right, for, you know, for a gym, or, you know, I want a pool, all that type of stuff. Financing, I'm not sure how familiar you guys are with the financing process. I'll kind of dive into it at the end, but normally, so projects are financed with a combination of debt and equity. Debt is just getting a bang from the loan, and then equity is, you know, it's private equity, so that's money coming out of the actual investor's pocket, that they're the ones actually investing in the property. So secure that, and then constructing, obviously, you know what that is. And so here I kind of gave you the four main asset classes for real estate, or commercial real estate. There's obviously residential, but we're focusing on the commercial side. So there's office, multifamily, retail, and industrial. Those are kind of the four main asset classes of commercial real estate. So office, so this is 255 East Brown in Birmingham, right? So pretty self-explanatory. You guys know what office buildings are. Multifamily, so this is 555 Woodward. This is also in downtown Birmingham. This is a luxury apartment complex. So when you hear the word multifamily, it just refers to mostly just apartment buildings or condos. It's a building that has more than one dwelling in it, right? So single family would, you know, a single family home is just a house, right? And so multifamily refers to, you know, multiple dwellings under one roof. Retail, so this is the Bloomfield Commons. So this is a shopping center just down the street where Stroh's is at, right? So this is, retail is just a place where, you know, consumers can go in and buy goods or services, right? Or, you know, so, you know, you got a Stroh's there, you got a Buddy's, you got a Verizon down there. So it's one real estate investor who owns the entire property, and what they do is they lease these spaces out. You know, he in conjunction with a broker, what he'll do is they'll try to attract tenants over to the shopping center to sign a lease and collect rental revenue. That's, you know, that's how these investments work. And then industrial. So industrial is kind of just what it sounds like. It's space used for industrial purposes. A lot of times, like logistics and warehousing and you know, Amazon fulfillment centers, right? That's logistics. So this is the Penske Logistics Fresh Center in Romulus. So this is over by the airport. So this is a fresh center, meaning cold storage. So they store food, and this serves all of Kroger for Michigan. So this is a pretty massive facility here. Now, if you guys had to take a guess, over the last, let's say 4 years, which of these two asset classes do you think are performing the best?
Industrial and retail or multifamily?
Multifamily.
Yeah.
Yeah. So industrial was completely blew up like 4 years ago, right? When COVID happened, retail kind of sort of shut down, right? You guys have been to some malls recently; they're completely dead. People are just ordering stuff online. Amazon, the demand for e-commerce and online shopping blew up. So did the demand for industrial properties. And then multifamily is it's a pretty steady recession-proof asset class. There's always going to be demand for multifamily. People always need to live, but during COVID, the cost of housing went up. People were still looking to rent, and then also during COVID, interest rates were just so low, right? Because the government was trying to stimulate the economy, and so developers could get loans for really cheap and kind of rent out apartment units for cheap. So that's kind of why multifamily blew up. There's a lot on here. I'm not going to go through all this, but I kind of wanted to explain of where real estate development is on this spectrum of types of real estate investment. So there's 3 types. There's core, value add, and opportunistic. Core is your lowest level of risk for real estate investment. These are already fully leased, fully functional buildings, right? So if you have a super sharp looking office building in Manhattan, right? That's fully leased, right? It's 96% occupied. That is what's called a core investment. And these are normally bought by big institutional investors or big pension funds like insurance companies, stuff like that. And then on the next level of risk, medium level risk is called value add investment. So these are buildings that are, right, so they have operational inefficiencies, they're not leasing a lot, or they're outdated, right? So this might be like, an office building that only has, 50% occupancy, right? This thing's half empty. And so what real estate investors will do is they'll try to buy it and put massive amounts of capital improvements into it, or they'll try to, put more into marketing and try to attract more tenants. And so, they can improve the lobbies of the building. They can add amenities, right? They can add, a gym to the building and make it more attractive for tenants. Okay, and so, and then the next is opportunistic. This is mostly where real estate development falls in, because this is the highest level of risk, right? So typically, you're buying a piece of dirt, you're buying a piece of land, or a completely dilapidated, vacant building with practically zero rent coming in, and you're trying to completely repurpose the land or the building, and so you're taking on the highest amount of risk, right? Because there's a lot of things that have to go in place, right? You got to buy the piece of land, you got to build a building, and then you got to lease it out, right? There's a lot of risk involved. There's a lot of things that could potentially go wrong, right? So that's why, so opportunistic is the highest level of real estate investment, or highest risk level of real estate investment. But with higher risk comes higher return. That's why you would get involved in an opportunistic investment. While you have a higher risk of losing money, your returns could be exponentially higher. So that's kind of the motivation for getting into real estate development. It's just more fun too, I think. So real estate development lies somewhere on the line here, right? On the value add or opportunistic level. So yeah, that's kind of where real estate development would lie on this level of real estate investment. Okay, so this is where we're gonna do a little exercise. So I'll kind of explain kind of what I do for my job. So, and at my previous job. So I would create financial models in Excel to assess the financial feasibility of buildings, right? So my job is to make sure, or to analyze a property, you know, a piece of land, and put in all these operating assumptions or inputs, right? And so I'm trying to see, does this building work? Can we make money on it? How much money will we make on it? Does it make sense to take on all this risk and, you know, invest our time and dollars into, you know, this piece of property or, you know, this piece of land, and right? And so what I did is I give you a little example of something, a small little deal I'm working on for Gleeson development. So we're looking at building a daycare facility in Hinsdale, Illinois. Daycare facilities are blowing up. You just heard Mr. Calmesian over there saying that, you know, he had to pick up his kids from daycare. It's becoming a very common thing now for parents to use daycare, as a lot of times both spouses will need to produce income, so they gotta leave their kid at daycare. But so daycare would be considered a retail asset class. So it's $1.7 million of land, $4 million of construction, or sometimes called hard costs, $800,000 of soft costs and other expenses. So this covers like legal fees, architectural fees, geotechnical surveys, appraisal fees, all this type of stuff. So it totals for around $6.5 million. We're gonna assume that there's an 80% loan to value loan. So the bank's gonna give us a loan of $5.2 million at 8% interest. Are you guys familiar with interest rates and stuff like that?
Yeah.
Right, so that's the rate that the bank is willing to, it's the rate that the bank is willing to borrow you the money at, so that's how much you have to pay in interest per month. And then $1.3 million of equity, so I kind of touched on that. So equity is just money that's coming out of the investor's pocket, but developers mostly won't take on all the equity by themselves. There's mostly what's called a general partner and a limited partner. The developer would be the general partner. We won't dive into that, so for the simplicity of this exercise, you know, we'll just say $1.3 million of private equity. And then the rent for the building is $50 per square foot and triple net rent. I'm not gonna go fully into what triple net rent is, but for office or retail leases, that means that the tenant would pay for insurance, real estate taxes, and CAM. CAM is common area maintenance, so that's like paying for like the upkeep of the lobbies, or paying for snow plowing, or mowing the lawns, right? You know, landscaping, stuff like that. So that's going to be $525,000 of NOI, net operating income per year. We'll assume that the landlord doesn't take on any operating expenses, right? So net operating income is definitely something that you guys want to be familiar with. So this is kind of what I do, just very simplified, right? $1.3 million down. You got $525,000 coming in every year. We'll assume a 2% rent bump in year 3. this is your mortgage payment, right? It's based on a 30-year amortization schedule. That just means how long you're paying down the principal of the loan, right? This is your net cash flow at the bottom, right? So obviously you put an investment there. You're netting, $63,000 per year. And then year 3, you decide to sell it. So you pay down your, annual mortgage payment. You sell it for $7.65 million. I'll show you how you got that. And then you got to pay off the remaining balance of your loan of $5 million. So I put a little amortization schedule here. You'll kind of see where I got that roughly $5 million that's still left on the loan, right? So this is something called cap rate. This is a very, very important metric used for real estate investors and real estate developers. So what the actual formula is net operating income, right? So that's your rental revenue minus all of your operating expenses. For this simple exercise, I didn't put any operating expenses, but normally there's at least some sort of operating expenses incurred from the landlord, divided by the property value. And so here, what we were trying to do is we were trying to decide what the property value was. How did I get the 7.65 million? Well, I assumed a 7% cap rate, and when you're on the sell side, a higher cap rate means you're going to get lower return because your property value is lower, and a lower cap rate means you're going to, sell your building for a lot more. So it's kind of like a almost like an equity multiplier for a stock evaluation, but this is for a building. And so in a good market, the cap rates will be lower, and in a bad and more risk-averse market, it'll be higher. And so here, I divided the year 3 NOI divided by 0.07, and that's how I got this 7.65 million sale proceed. And then there's something called the internal rate of return. That's a finance term. If any of you guys are going to take finance in college, you'll probably learn what that is. That's the return of an investment discounted to the present value of the dollar, right? So I'm sure you guys have heard, inflation occurs every year. So the value of the dollar loses over time, and so $1 today is worth a lot more than $1, 10 years from now, right? So that's kind of what this calculation is. So this is a 30% return. This is a slam dunk. That's a home run, right? Normally you try to aim for at least 18 to 20% return. If you can get 30% return, you're doing well. Yeah, and so that's kind of it. I just kind of wanted to show you just kind of in a nutshell of the analysis that I do. Yeah, I think we'll move it for questions. I don't know how much time we have. I don't know if okay, we got 10 minutes left. Yeah. So yeah, I'll open up the questions. Yeah.
Well, on the bottom one, the bottom amortization schedule, what is the amortization column? What do those numbers mean?
So amortization is when you take out a loan. So I said a 30-year amortization schedule. That is how long you're willing to pay down the principal. The principal meaning the actual amount, $5.2 million. So a traditional loan, like for a single-family house, is normally a 30-year amortization schedule. And so, so you see here, I broke it down. So there's interest plus amortization. As this goes on, so if I extended this out for the full 30 years, you would see that the amortization, your monthly payments still stays the same. You find that out in a formula through Excel, right? There's 400. That's the annual payment, but as this moves along down here, you will pay off, you will chip away at the principal of your loan more per year, while your interest payment, so that is this 8% of your principal, that will start to decrease. So you're starting to chip away at the actual amount that you're being lent. That's the best way I can describe it. I know it's a lot today, but that's kind of how loans work for both a house or for a piece of real estate.
So it's the actual principal that you're paying down each year, not just, because the 400 grand is the interest, then if you add the two, that you get your mortgage payment.
Yeah, right, exactly. So your mortgage payment is a combination of your interest and amortization. So paying down the principal of the loan.
Gotcha.
Yep. Or, yeah, go ahead.
What was the biggest deal or project you've been a part of?
Good question. So when I worked for IBT Group in Chicago, I was working on a $180 million deal. It was it was that life science concept, right? So we're trying to expand our footprint and do another life science facility in Chicago in kind of a emerging neighborhood, I guess we'll call it. And we're also going to incorporate multifamily housing and then actually some freestanding retail. And that was dependent on a lot of different, what are called TIFs, tax increment financing. So those are tools given by the city to help developers fill financing gaps, right? Because the deal did not pencil, we would have lost millions of dollars, but we went to the city and said, hey, give us some help. So boom, gave us some help, and there was some other stuff like historical tax credits, new market tax credits. There's all these different tools that developers can use to help finance their project, because cities want to make these projects happen. They collect more tax revenue, and it just can transform a neighborhood, right? They don't just want ugly eyesores or just empty pieces of land, right, in their city. Who would? So, but yeah, that's the biggest one I've worked on. Yep.
So, a 7% cap rate, that's pretty average to good, right?
Yeah, it is for retail. So every asset class kind of will have a different cap rate. Like for office right now, office is not too hot. There's not many people, right? A lot of people are working remote. While some return to office is happening, cap rate for office will probably be in the 8.5 to 9 range. Retail, I actually went a little bit conservative. You can probably get retail in the 6.5 to 7 range. Multifamily, you can probably get 5, in between 5 or 6, depending on the market. So it doesn't just depend on the asset class, but it also depends on the market you're in. So if you're in New York, right, a high-paying, everyone's gonna, right, there's a high demand, right, for multifamily. You could probably get a sub 5. You could get a 4.5, 4.75 cap rate. So it all depends on the market you're in. Yep.
Yeah, so what right now, obviously you said multifamily is very solid, but what else, what's your main, you look to sell a contract, or you look to go into something, what's your go-to?
For my job, what deals am I looking
Yeah,
at?
exactly, what do you see?
I mean, honestly, anything that'll make us money. Yeah, and stuff that, with Gleeson development, honestly, we're looking at a lot of retail.
Yeah.
Because we have Gleeson Constructors has a lot of experience building retail, and these deals are a little bit easier to work with. And so, since Gleeson Constructors has a lot of experience building it, we think it just makes sense to go after these kind of single-tenant retail facilities. My presentation took a little longer than I thought, sorry, but if you guys have any other questions, I guess one more and we can wrap up, or?
Yeah, we can do a few more.
A few more, okay, yeah, go ahead.
What's your favorite project you worked on?
My favorite project I've worked on? I mean, the big one I was talking about was fun, but it was stressful. Right now, what we're working on is we're trying to, Calmesian was he was asking me about the club studio. So we built that club studio on Maple and Coolidge. I'm sure maybe some of you will join there. I don't know, it might be, I don't know if it's too expensive, but we built over 200 LA Fitnesses across the country, and so what we're trying to do is get in front of the LA Fitness executives and just be like, hey, we built 200 plus of these all across the country. Let us become the developer, so we'll develop and have an ownership, a piece of equity in the actual property, and let us build it too. So right now, I'm working on getting a pitch together for the LA Fitness executive, so that's pretty exciting.
Alright.
Is that the pickleball place?
Yes.
Yeah.
Yes.
I know.
Yep.
Wait, is that with Gleeson Development, or is that with one of your?
No, that's Gleeson Constructor. So Gleeson Development, I should say, this just formed 6 months ago, I would say, and so I joined like 4 months ago. And so I'm trying to help us get started and get us involved in the real estate development world. We don't have any real estate development projects yet, but that's why I came aboard, to get us involved in the actual real estate development world. So kind of using my experience in Chicago, I'm gonna help us get there. And we're trying to start off small, like right with this daycare, and then hopefully LA Fitness.
You said you were gonna pitch together for LA Fitness. Do you do that a lot? Do you go in front of
Yeah.
companies and pitch them ideas? Or?
Yeah, definitely. Like a lot of my job is putting together investment packages, right? So when I create a financial model, so this will normally be an Excel, right? So I'll create a financial model in Excel, and then what I'll do is kind of put together a little marketing package. I'll put in all the market demographics. All right, here's the income levels for this area. Here's kind of what people are paying for rent for apartments, blah blah blah. And I'll put it together, in a PowerPoint, and I'll also put in figures like this, right? And I'll present that to a bank or to another private equity investor, right? But yeah, that's a big part of my job.
Alright.
Thanks for having me, guys.
Yeah.
One quick thing. If any of you are looking for a summer job, Gleeson Constructors, we hire. So when I was in high school, I worked on construction job sites every summer. It's a good gig. You get paid to